In this free course, I'm going to show you how to create the ultimate proven 3-fund portfolio that can make you an investing millionaire. Now, this course is completely free, you guys, but if you guys do want to use the links down below to get some free stocks on Moomoo, that would definitely help the channel and make videos like this possible. Now, I'm super excited about this video because, a lot of people think I need a very complex investing strategy to make a lot of money. Well, if you're the average investor, what I'll say is that the best portfolio for you is going to be something simple like this. And yeah, in this video, we'll cover everything you need to know about the 3-fund portfolio and how you guys can use it to build your wealth. So here's an overview of what we'll cover in this video. I recommend just pausing this video if you want and taking a look at this. But yeah, basically it's going to be pretty in-depth. And what I recommend you guys do is actually take out a notebook and take some notes. It'll be a lot easier for you guys to reference later on. And as you guys can see, there is a lot of really important information. First, let's talk about why investing is the way to go, right? So when you're investing, you are basically having your money work for you. The whole act of having money in the markets is able to help you make money. And so you're not actively trading your time to make that money. This allows you to build wealth. It's relatively safe as long as you do your own research, your own due diligence, and you invest responsibly, which basically this video is going to teach you how to do. And when you do all this correctly, it's going to allow you to achieve financial independence. No one got wealthy just having their money sitting in a checking account, not making any returns. Instead, everyone invests their money either in stocks, crypto, real estate. There are tons of other investments out there. But yeah, a very, very big one in the past 100 years has been investing in stocks. And this video is going to explore a proven strategy that should allow you to get a lot of really good gains over the long term. Now, what does it mean to actually build a good investment portfolio? Let's first talk about what an investment portfolio is, right? This is basically just all the different assets that you invest in. So just like some of the things we talked about, it can be stocks, crypto, real estate, whatever. When building out the right investment portfolio for yourself, you need to think about the diversity. You need to think about the different securities you're investing in. You need to think about the stability of it and also the growth potential. So everyone's investment portfolio is going to be a little bit different depending on when you start investing, right? Younger investors are probably going to be a little bit more risky, whereas older investors that are closer to retirement are going to want to stick more with things like bonds and things that are relatively safer. Now, a common misconception is that the more complex your investing strategy, the better. And the reason why this is not always true falls on a few different things. Firstly, the more complex your portfolio is, the harder it is to actually understand what you're investing in, right? And I don't recommend you guys invest in things that you don't understand. So unless you're able to spend a lot of time actually knowing what you're investing in, for example, if you're day trading, that means you're going to have to actively follow the markets every single day. And I just don't recommend having that as part of your investing strategy. More complex also means that it's usually more expensive. So for example, portfolios with more diversity or less common assets tend to cost more to actually maintain. So now let's dive into what a 3-fund portfolio is. It's an investment portfolio where you invest in 3 different index funds. These are passively managed index funds with very low expense ratios, meaning you're paying very, very little fees. In terms of the 3 different funds for this type of portfolio, you'll have one fund that covers US stocks, you'll have one fund that actually covers international stocks, and you'll have one fund that covers US bonds. Do you need to invest in all 3 of these? No, you don't. You can invest in a mixture of them. But I think most people, including myself, would say you want to diversify a little bit, and it's usually beneficial to have all 3. When you have a portfolio like this, you're able to, 1, invest money around the world, 2, you'll be able to mitigate individual stock risk, and 3, you're going to be able to earn money from global assets. So now essentially what we're going to do is we're going to break this type of portfolio into 3 different parts. You guys can actually use a 1-fund portfolio, a 2-fund portfolio, or a 3-fund portfolio. The more funds, the more complex, and of course, the more you're actually investing into. So let's start with the 1-fund portfolio, which is just buying US stocks. This is the first component of the 3-fund portfolio. And basically when you're investing in US stocks, of course, it just means that you're betting on the best US company. This is going to depend on which index you're investing in, but for most of you guys watching this video, I'd recommend something like the S&P 500. The returns of the S&P 500 index over the last century has been around 10% per year. And here are some examples of some major US companies. If you live in the US or you are a consumer, you've probably heard of most of these companies. And yeah, basically what the S&P 500 stands for is it's the 500 largest companies on the stock market in the US. The index tracks the performance of the S&P 500, and ever since the index's inception, it's increased by nearly 2,700%. You guys can see on the right, here is a chart of the growth. And yeah, in the long term, it's just performed exceptionally well. Now I will say you can't can't actually just invest directly in the S&P 500 index because that's not possible. However, there are assets that actually mirror this index. These are basically funds that track the S&P 500 index, all the companies within them. And these managers, they buy the same stocks or similar weightings that are in the S&P 500. And basically you can invest in that fund and it's just like owning all 500 of those companies. Some of the best examples that we're going to go over in this video are the Vanguard S&P 500 ETF, VOO. This is a very, very popular one. There's the Vanguard 500 Index Fund Admiral Shares, and there's the Vanguard Total Stock Market Index ETF, VTI. Although different S&P 500 funds try to be as identical to the original index as possible, there are still some things and differences that you should consider. For example, VOO versus VTI, right? VOO tracks the S&P 500, whereas VTI tracks the total US stock market. So that's literally going to be thousands of different companies that are publicly traded. The key differences between these types of funds is one, the portfolio, two, the expense ratio, which is basically the percent of assets used to maintain the fund, which you guys is basically how much you are paying. And yeah, an example calculation for this is if you have a fund with an expense ratio of 1% and you have $100 within that fund, that means that every single year you'll be paying $1 in fees. Three, you have total fund assets. So how much wealth does the fund actually have? How many net assets are in it? And then four, how dividends are paid out. So let's take a closer look at VOO. This is probably one of the most popular ETFs out there. So depending on when you're watching this video, of course, these prices are going to be a little bit different. But as of right now, the market price for VOO is about $360. That's how much it costs to purchase one share of this. The expense ratio is 0.03%, which is very, very low, basically meaning you pay $3 in fees for every $10,000 you invest. The fund total net assets is $789.6 billion. So a very, very big fund for sure. It has a current dividend yield of about 1.66%, which means it pays out 1.66% of the stock price every single year. The minimum investment to get into this is $1 and it holds 503 different stocks. VFIAX, this is the mutual fund version of VOO. And there are some differences between the ETF and a mutual fund like this, but basically all purchases for VFIAX are bundled together until the end of trading. You can't trade one stock at any time of the day. Whereas with VOO, you can trade one share of VOO at any time during market hours. And yeah, with a mutual fund, all orders received in a given day receive the same exact share price. Now the expense ratio for VFIAX is just a little bit higher. It's 0.04%, meaning you're paying $4 for every $10,000 invested. They also have a ton of net assets. They have the exact same dividend yield, but I will say that they have a higher minimum investment of $3,000. Next, let's talk about VTI, which is Vanguard's Total Stock Market Index ETF. Instead of just 500 different companies, this is going to track the entire US stock market. So we have large cap, mid cap, and small cap stocks. It's under $200 per share right now. It has an expense ratio of 0.03%. Absolutely gigantic with over $1 trillion in net assets. It has a dividend yield of 1.64% and holds about 4,000 different stocks. So yeah, this is a better choice if you want to invest in all the different companies in the US. Whereas if you only care about the biggest 500 companies in the US, that's when you'd go with something like VOO. So if you want to keep things extremely simple, you'll just have a one fund portfolio and you'll basically just invest in US stocks using 1, 2, or 3 of those US funds. So now how do you actually buy these ETFs? I recommend using a platform called Moomoo. This is one of my go-to apps for investing in stocks. Moomoo is super awesome, and right now they're actually giving you guys a ton of free stocks when you use my link down below and sign up and fund your account. As I'm filming this video, they're giving up to 17 free stocks, which is just crazy. Now, why do I actually recommend Moomoo? Now, I've been using Moomoo for a couple of years now, and I'm one of nearly 20 million people that use the platform to invest in stocks. They allow you to place orders 24/7. They have charting tools, 63 technical indicators, as well as free level 2 data. So I have Moomoo pulled up right here. I'm gonna come up here to search, look up VOO. We'll click on that. And from here, I'll actually be able to buy this ETF super fast. I'll click on trade down here. We can choose our order type. So let's do market for this video. I'll buy, let's say 2, and then I'll click on buy like this. I'll have me confirm the details, and then I can click confirm to buy. Another really cool feature is that I can actually set price alerts. So if I come here to alerts, I can click add like this. Let's say I want to buy VOO when the price drops down to $360. I'll come here, click on this. We'll put 360 right here, and then we'll click complete. You can also use Moomoo to actually find different ETFs to invest in. So if I come here to markets, click on US, come down here to ETFs. It's going to show me all the ETFs by region, equity indices, commodity, bonds, so on. So yeah, tons of helpful tools that will make you a better investor. Anyways, like I mentioned earlier, Moomoo is giving out a ton of free stocks when you sign up using my link down below. And yeah, highly recommend you guys check them out. Now let's talk about a 2-fund portfolio, right? So this is going to include our US stock portion as well as international stocks. So investing in an international stock index means you're betting on, of course, companies that are outside of the US. And historically, way, international stocks have outperformed US stocks during around 50% of all time periods over the last half century. You guys can take a look at the data on the right. But yeah, recently US stocks have definitely performed better than international stocks. Here are some examples of some major international companies. A lot of these you guys might know and didn't know that they were actually international. But yeah, there are a lot of really great companies that are based outside of the US. Now let's talk about some of the most popular international stock funds that you guys can invest in. There's the Vanguard Total International Stock ETF, VXUS. There's the Vanguard Total World Stock ETF, stock ticker VT. And there's the Vanguard FTSE Developed Markets ETF, VEA. In this video, we're really focusing on Vanguard funds because they have really low expense ratios. I use them a lot myself, and these funds are available for purchase on Webull, Moomoo, and pretty much any other stock platform. Now, with international stock funds, there are some really big differences that you guys should be aware of. And going back to the US stock fund differences, it's pretty much the exact same thing. The type of portfolio, the expense ratio, total fund assets, as well as the dividend payouts. Now, let's take a closer look at VXUS, which is one of the most popular international stock ETFs that you guys can buy. This tracks the FTSE Global All Cap X US Index. Right now they're trading for over $50 a share. They have an expense ratio of 0.07%, so a little bit higher than the US stock ones, and basically just means you're paying $7 per 10,000 invested, which is not bad. The fund total net assets is $360 billion. They have a pretty good dividend yield of 2.96%, and this fund holds almost 8,000 different stocks. Let's also take a closer look at VT, which is the Vanguard Total World Stock ETF. This one tracks the FTSE Global All Cap Index. It's trading at about $89 a share with an expense ratio of 0.07% as well. It does have a lower dividend yield than VXUS, but this one actually holds even more stocks at almost 10,000. Then we have the Vanguard FTSE Developed Markets ETF, stock ticker VEA. So this is going to hold stocks in companies that are more from developed markets, such as Japan, the UK, Canada, France, etc. You guys can take a look at the stats right here, and the thing that stands out for me here is the expense ratio of 0.05%, which is a bit lower, which is great. And this one does hold about 4,000 different stocks. So yeah, if you guys want to incorporate international stocks into your portfolio, you'd likely add one of these funds that we talked about or a mixture of them. However, I don't recommend only investing in international companies unless that's the only market that you actually believe in. For most of you guys watching this video, it's probably gonna be best to invest in US stocks. And then if you have extra money, you'll invest in international stocks. And then if you want to allocate even more money towards the third portion of this portfolio, that's when we get into US bonds. So with US bonds, here is basically how it works. When you're buying a bond, you're basically lending money to the US government. And then the US government, they say, okay, we're gonna pay you back that much money plus interest later on. Bonds are way less volatile than stocks. That's why a lot of people closer to retirement age tend to stray towards US bonds. It's more of a guaranteed return, whereas US stocks, international stocks, these can fluctuate in value quite a bit. And so yeah, if you're retiring in a year where all the stocks are down a lot, this can have a really big negative effect on your retirement. So that's why older people are a bit more conservative and they prefer US bonds. US bonds actually often move in opposing directions compared to actual stocks. So this can be a way to actually hedge your losses in case stocks do go down. Now, there are some really great funds from Vanguard that do track US bonds. For example, we have the Vanguard Total Bond Market Index Fund, VBTLX. We have the Vanguard Total Bond Market ETF, BND, and we have the Vanguard Total Corporate Bond ETF, VTC. So just like with the US stocks and the international stocks, there are some different things you guys should be aware of. The first four are exactly the same as we've talked about before, but number 5 is the distribution by credit quality. So bonds come with these ratings by Moody's and Standard & Poor's. And you guys can see on this little chart right here, it's going to sort of outline those different ratings. These basically describe the quality of those bonds, ranging from C and D to AAA. We also have a different type of grades. So you have investment grade and junk grade. And this chart also shows the different risk for each of these ratings. Now let's zoom into VBTLX. This is a mutual fund that tracks the Bloomberg US Index. We currently have a price of $9.69. The expense ratio is 0.07%. We have dividend of 2.46%, a minimum investment of $3,000, and it holds over 10,000 different bonds. You can see a majority of these are going to be US government bonds, followed by BBB rated bonds, A rated, AAA rated, and AA rated. You also have the Vanguard Total Bond Market ETF, BND. This is virtually the same as VBTLX. The expense ratio is a little bit lower, which is good. And this one holds over 10,000 different bonds, with of course a majority of them being US government bonds. And then there's also VTC. This one tracks the Bloomberg US Corporate Bond Index. And the reason why this one's a little bit different is because it places greater emphasis on bonds issued issued by corporations over government issued bonds. So we have an expense ratio of 0.04%, dividend yield of 3.04% as of right now, and it holds over 7,000 bonds with 84.2% exposure to US bond markets. So now let's talk about some of the benefits of the 3-fund portfolio. Basically, when you're buying total market index funds like these that we've talked about, you have money invested across so many different assets. This includes having your money in really attractive stocks that you always hear about in the news, but it also does include a lot of companies and stocks that you just are not going to know. And the thing is, when you have strong diversity, when you're invested across many different companies, this actually lowers the risk and it lowers the volatility. Also, when you are incorporating the 3-fund portfolio concepts, you're actually avoiding a lot of redundancy and overlap. Basically, you have money in the US stocks, which is one separate thing. Then you also have money in international stocks, which don't overlap. And you have money in US bonds, which of course also don't overlap. It also allows you to avoid the risks of investing into individual stocks. Stock picking is actually extremely hard. I know it is fun to actually research companies and sort of, gamble by picking ones that you like, but studies show that most people that pick their stocks, they actually lose compared to the overall market. And so yeah, that's why for most investors, it just makes more sense to invest in index funds like these and save your mental energy to actually build your business, make your money, and just live life. So when they're investing in multiple companies through these index funds, they're basically investing in the markets, which we do expect to go up in the long term. Also, by investing in these index funds, it's going to make you actually less likely to hire a financial advisor. Now, not all financial advisors are bad, but I will say that there are a lot of them that don't add that much value to you while still taking like 1% of your portfolio. And that over time, you guys can really add up. So if you really compare that 1%, which is pretty standard, to like 0.03%, which is what you're paying with most of these index funds, then you guys can see the savings is absolutely drastic. And over, let's say 30, 40, 50 years, that can literally equate to millions of dollars in savings. Also, guys, remember that index funds are passively managed. And that's literally the reason why these expense ratios are just so low. You're able to achieve portfolio diversity and stability at such low costs. And of course, there is only one catch with this. It's that you won't get rich really fast. Now, of course, the chances of you getting rich really fast by picking stocks, day trading, all that stuff is extremely low, but it certainly is possible for a very select few people. However, when you invest in a portfolio like this over the long term, you're getting a lot of steady growth that has a proven track record over history. And this is really what most investors are going to recommend doing, especially people like Warren Buffett. Another huge benefit of this type of portfolio is the simplicity. The 3-fund portfolio is sometimes called the lazy portfolio, and that's because it's super simple, it's very straightforward, and yeah, like I said earlier, it allows you to focus on more important things like actually increasing your income so you have more money to invest. So yeah, really, if you guys want to take advantage of the 3-fund portfolio, it can be really as simple as this. You buy one fund for the US stock market, you buy one fund for international stocks, and then you buy one fund for US bonds. Some of you guys might want to take out the bonds section if you are young and you don't really care about that stability. But yeah, that's basically it. It's super simple. You guys can literally create this right after watching this video, and you're gonna have money in the markets that should grow over the long term. I just want you guys to know that there are such easy ways to invest your money that are not complicated, that you guys can learn relatively quickly. And if that helps more of you guys get into the markets, then that's pretty much all I want. So now let's talk about actually creating your 3-fund portfolio. I would say choose a lower expense ratio if possible. Of course, all the funds we covered in this video have very low expense ratios, so you really can't go wrong with any of them. You'll also want to shoot for a fund with higher total net assets. That basically just means there's more liquidity. And of course, you want to look at the dividends, although this should not be that important. It's just really an added bonus for seeing your assets grow in value, as well as getting an annual dividend payment. Also, the more diversified, the better. Then this is not going to matter as much. And also, you want to look at the distribution of assets. Now, of course, with this video, my main purpose is to help you guys take action and start putting your money into the markets, because studies show that the earlier you start investing, the more you can take advantage of compound interest, compound growth, and exponential growth, and the more money you will make by the time you retire. So consider how much money you want to invest. I say the best ROI you're ever going to get probably is to invest in yourself and whatever business you want to start. But while you're doing that, you should also always put money into assets like this. Of course, it really depends on your goals, your risk tolerance. And yeah, my main thing when it comes to investing is just buy things and hold them. Don't try and actively buy and sell, sell. You're not gonna be able to time the market. And like I said earlier, these funds, they are not designed to be rapid growth. They're not going to 10x within 1 year. They're designed more to be stable and sustainable for the long run. So yeah, that's basically it for this video. I really hope you guys got some value out of this free course about the 3 fund portfolio. I really hope this video shows you just how simple investing can be. And like I mentioned earlier, you guys can use the links down below to get started investing with a bunch of free stocks. That's literally free money just for signing up for these platforms. I use Moomoo myself. I literally have hundreds of thousands of dollars on those platforms. They really make investing in stocks super simple for all traders. Cool, so that's it for this video. I really hope you guys enjoyed it. If you guys did, make sure to hit that like button and also subscribe for more content just like this. I make a ton of videos about personal finance, investing, and entrepreneurship. Thank you so much for your time, and I'll see you in the next video. Peace.